Hi, Kristin Cooper here, your Certified Mortgage Planning Specialist, and today we're going to talk about acquisition indebtedness, what it looks like, and when it is qualified for that. And so we're going to talk about first about taxes. And so they changed the standard tax deduction. So you need to find out first, can you itemize? Are you able to itemize your deductions? And does the mortgage interest deduction help you? And does it really even matter? And so you want to talk with your CPA or tax professional. I'm not a tax professional. It's just simply to give you information so that you can talk with your tax person and find out what's specific to you. So they did change the laws to where now under standard deduction, you get $12,000 as the standard deduction if you're single, $18,000 if you're head of household, and $24,000 for a married joint filing. And so you need to see if your itemization deductions are going to oversee that amount or overdo that amount. If not, then you may not even be needing to use the mortgage interest deduction. So you want to talk with your tax person. But let's say that you are doing itemized deductions and you are utilizing the mortgage interest deduction. We need to make sure that what you're claiming as your interest deduction is appropriate. And so we need to find out, is it a qualified residence? In order for it to be a qualified residence, it needs to be your primary home or your second home, one of each, one primary, one second home, or vacation home. If it's one of those two, then it's a qualified residence. And then we need to see, is it classified, is the mortgage classified under acquisition indebtedness? What does that mean? So acquisition indebtedness, there's a bucket. And so they changed it to where this bucket, if it's a qualified residence, a primary or the second home, then you can deduct up to $750,000 in qualified mortgages. Now that means that the money that you're using for the mortgages had to have been to buy, build, or improve. So if you took out cash and it wasn't to buy, build, or improve, then it is not a taxable mortgage interest. And so it will be itemized on your tax form if it's going to be a qualified interest or not. So if you see that there's a difference, it could be that you took cash out and it wasn't used to buy, build, or improve. If you took cash out and it was used for that, then you want to make sure you let your tax professional know that you used it for improvements, to make sure that they know if it's used for qualified indebtedness. Again, it has to be documented forms and specific improvements, but let your tax professional know. So let's say that you bought a home for $400,000 as your primary residence. That can go in the bucket, and you're under $750,000, so you get to write off that mortgage deduction. Let's say that you went and bought a vacation home at $200,000 mortgage. Now that $200,000 to $400,000 is $600,000, which is still under the $750,000 total for a qualified residence as a primary second home, and it was used to buy, build, or improve. So its mortgage interest deduction is tax deductible. Let's say that you purchased the property and you took out $100,000 to put towards your business or something like that. Well, that's not used to buy, build, or improve the home, and so it's not considered a mortgage interest deduction. So why this is important is that I'm a certified mortgage planning specialist, so when we sit down, we want to make sure we're structuring it best and appropriate for you, because if you are itemizing, there may be different ways that we'd want to look at structuring the loan to make sure that it's working for you, that you're getting the tax deductions that are needed for that property. So if you have questions specifically to this, again, you can talk to your CPA, tax advisor, reach out to me as a certified mortgage planning specialist. I'm here to make sure that we're doing what's best for you, that we're using strategic planning to make sure that we're looking at tax as well as the opportunities for your goals moving forward. Again, this is Kristin Cooper, your certified mortgage planning specialist, and hope you have a wonderful day.